Welcome to week 22 of 50. This week we're covering managed term, top 5 critical consumer insights. Welcome to this week's class of Math.Logic.Wealth. I'm Jeff Cait, and let me tell you about the Fat Boys Club. Every Sunday, 100 of us would trudge up this metal staircase like elephants, praying it would hold, to a room with exactly 100 chairs. One week, our host Harvey Brooker announced he'd reveal the secret to weight loss. His secret? You do it because you care about yourself in the future. It's not about today. Now, I want you to keep that in mind because nobody has to do managed term. It doesn't solve today's problem by putting $1 million of term 20 in a drawer. Managed term is for people who care about their future selves. First thing consumers must understand is the massive cost advantage. If you do the math, a family needing $2 million of coverage, let's say $3,000 to $4,000 annually with term versus $80,000 for equivalent permanent coverage, this efficiency advantage is about caring for your future self. Here's the math: $1 million in permanent insurance, for an example, or $45 million in term insurance. The mathematical advantage is undeniable. What consumers need to understand is fair market value thinking. Life insurance as a financial asset. Like any investment, life insurance has fair market value. As you age, the value approaches the death benefit. The value increases daily in most circumstances, and this is why contract features matter more than price. Company A offers conversion at rates then in effect, while Company B guarantees standard rates. Thousands of difference in value. And when you're looking at it, you can see what are the criteria for selecting a term product today in terms of providing in your reason why letter why you selected which term product you did. We weight policy contract 50%, extra features gets 30%, and the price, only the price is only 20%. Desjardins ranks first for not just for lowest price today in our rankings, but for superior contract language. We can read the policy contracts and calculate the real differences. Next on our list of most important for consumers to understand is diversification captures the advantages, and it does it at the same time while reducing the risk. So don't put all life insurance with one company. 1.5 million split across 3 companies costs similar to single company coverage while providing better features and reduced risk. This is the tree analogy. You go up a tree with a client, meeting branches, satisfying them to continue the climb. We construct a managed term tree. Every 5 years, you got options to change, to convert, to cancel, to donate. The base is life. The base of the tree is life, and the branches are on-ramps and off-ramps for an unknown future. What consumers have to understand is you can look at the math behind term now and convert later. We can compare term to permanent purchases now versus doing it later. The mathematical analysis often shows that term-first strategies outperform forced premature permanent purchases. Here's an excerpt from my book. I did it for a 57-year-old from my book. And what it says is, oh, the life insurance advisors say term insurance is a waste. And we say, okay, show me your math. I did the math for my 57-year-old client. And option 1, permanent insurance now, the IRR is 3.3% to life expectancy. Option 2, term now, convert later, the IRR is 3.1% to life expectancy. Only a 0.2% difference. For consumers under 50, the advantage is typically minimal or non-existent. Let's talk about the science of optionality. We're in the optionality business. Death benefit coverage is almost a free byproduct. When you purchase convertible term, you're buying 2 instruments: current mortality coverage and embedded options to purchase permanent insurance at standard rates, regardless of future health changes. This is where product knowledge becomes essential and, from my perspective, frankly, a lot of fun. Johnny Bauer's story. 42-year-old goaltender sitting on the bench. Terry Sawchuk loses game one of the 67 final series, the final series of the playoffs in the NHL. Bauer takes over. Can you imagine turning to a 42-year-old option in the Stanley Cup finals? And what if the Leafs didn't have that option? How much longer would we now be waiting for a championship? Remember Harvey Brooker's lesson. You do this because you care about yourself in the future. And here are the 5 insights for today for consumers. Talk about the cost advantage. We make sure that they understand fair market value thinking. We look at diversification. We do mathematical timing. And finally, the science of optionality. Managed term creates valuable options for your future self. And that's what we try to do. Best information we got every week here. And thanks for joining us.